we've heard from a number of investors, government entities, and BDC really fits in the middle of everybody that you've seen here today. It's a bit of an incestuous flock of people. There's a lot of money around the table, but really we are targeting a number of companies to try and create successful, high-growth businesses, and that's what the technology venture capital industry is all about. So I'll talk a little bit more about the relationships with the others and throughout the presentation, but I just wanted to say that we've worked with every single one of these groups in a deal over the course of the last 12, 18 months. And so it really, truly is a syndicate type of approach. So just want to tell you a little bit about the history of BDC and how we are positioned against the rest of the group here. We're very old. We were created in 1944. We were created to fill gaps in the financial markets in Canada. We're a Crown corporation and we get our money from the government of Canada, but we also have floated bonds in the past, and some bonds still exist out there. We are for-profit. I think that's what distinguishes us from SDTC and IRAP, NRC IRAP, is that we are a for-profit company, and for the past 45 years we've been a profitable entity contributing back to the Canadian taxpayer. We have divisions like consulting, loans, which many of you may be familiar with because they touch a broad range and thousands of businesses across Canada. And we also have subordinated debt and venture capital. We're only involved in the venture capital side and technology VC funding, but we have been involved in that since the 1980s and have had a very good track record throughout that period of time. In the VC, in the technology space, we focus on ICT, life sciences, and EEM, which I'll explain that in acronym a little bit later. And you can see the size of the fund and some of the wins that we've had. So EEM, energy, environment, electronics, materials. All of those apply to Cleantech, but probably a better characterization is Cleantech, semiconductors, and materials-based lending or investing. We currently have a portfolio of about 25 companies, and we're often the lead investor because we get in at a very early stage, sometimes even before SDTC. Actually, almost all the time before SDTC. But of course, as a lead investor, we put together the management teams, we work and build the companies, and hopefully we get them to the next stage so other investors can come and syndicate with us and build very strong companies. Our investment range is $500,000 to $5 million in our first investment. We can go as high as $15 million per investment. We have certain requirements for equity and term, and we've made a number of recent Cleantech investments, a couple of which Keith talked about earlier in his presentation, and others across Canada. So why Cleantech? I think everyone's covered this. There's a lot of money going into it. I've got a few reasons here about market-specific data. I can tell you there's $150 billion in government incentives that at the beginning of this year, less than 10% was allocated. It's a very hot space. Public opinion likes this space. Industry likes this space, and there's some very big players. So it makes sense to chase or to invest in an area where there is a significant pull. So we have some investing criteria. Since we are an arm of the Canadian government, we must have Canadian expertise in global competitiveness. It does not necessarily have to be a Canadian company, but it has to have a substantial connection to Canada. We must invest in the areas that we've identified. Management is an important key, and the availability or the ability to attract a management team is important for any investment that we make. Sustainable competitive advantage, of course. We also want something that solves more than a local issue. So putting up a wind farm in northern Alberta to generate electricity for local use is not something that we would be attracted to. It has to have an international market and a large quantifiable worldwide market in the billions of dollars. The issue being solved has to be material, but is also manageable. There's often material issues that are not manageable, and in some cases we've invested in a company such as General Fusion where we're not sure whether it's manageable, but we're going to take a shot at doing it anyway. Technology must be competitive in an unsubsidized market. India, China have thrown money at this particular sector and are creating technologies that are world competitive and will change the face of how the future will unfold. We have to compete with those technologies. So if we're thinking that we can create a technology that's sellable in North America at a certain price, we have to be able to sell it in a worldwide markets in China and India at a price that beats that competition and makes sense to build in that case. That's a heck of a challenge, but that's a challenge that we're moving towards. Scalability, of course, is necessary, and manageable startup costs. Many clean tech solutions require significant capital investment. The BDC's venture capital fund cannot address that, and so cannot address significant capital investments. So we just can't play into those areas. Building biofuel plants, building large wind funds, building waste-to-energy facilities is not the type of investment that we can look at because of the capital intensity needed in those investments. Now, there are others in the audience, like STTC, that can work towards that, and of course, we look to them to focus in bringing their syndicates or partnerships together. I think their consortia together in order to do that. And of course, at some point in time, we have to sell. So I know this is often difficult for the founding entrepreneurs, but it is something that has to be put into the game plan. It has to be thought of at the beginning, and is important in order to revive or recycle that cash into other investments into the Canadian economy. So since these guys talked about all of the markets and all sorts of things, I thought I'd talk about how to approach a VC, because many of the companies were very early stage that presented today. They also put me last, so there wasn't that many topics left to talk about. And I thought I could do it relatively quickly so we could maybe get you out here on time. So first of all, how do you approach us? Well, the best way to approach it is through a contact. So if you have friends that know VCs and can get a referral, it's a heck of a lot easier to get in the door than just calling us up cold or sending us a business plan over the internet or however. So look for your contacts, and you may be able to contact us through one of these people. We know all of the people, they know all of us. And if you get a referral, it's a lot better for you to get time. We see thousands of business plans every year, so time is a premium. If you do get a contact, send an executive summary first. Make sure it's impactful and to the point and tells what the opportunity is. Some of the things that I said on the previous slide. If you don't do that, it's going to be lost. If it's too wordy or too much on the technology, it doesn't explain the business case, you're not going to get a meeting. So the idea is next to get a meeting, or to have the VC ask for your business plan. So have that ready if you get to that stage. And ultimately, when you have a meeting, translate that executive summary into a PowerPoint pitch and be prepared for being bombarded with questions, because VCs like to think that they know everything and will ask lots of questions, many times even irrelevant ones, but be prepared for anything from left and right field. So what is the process? Well, this is our process. It's not that much different than many of the other processes around, but first you contact us, you go through what I explained. If you get through that, we'll do some preliminary due diligence. We'll visit your site. We'll talk to some of your management teams. If we like that, we'll get to a much more detailed due diligence, and be prepared to have everything checked, including your underwear. I'm just kidding about that, but be prepared to open up your files very in depth. We'll negotiate and sign a term sheet, and the next step is very important. Once we've done that, we still need a committee. Every venture capital firm will still require a committee to authorize that investment. They need either partner authorization or others. So that type of authorization is still necessary. Finally, you get to the legal documentation, and then you close and the check is dispersed. This process is not slow. It's often related to the quality and speed at which the due diligence is provided by the company, but can often be 4 to 12 months. I think with Switch, for example, we were a follow-on investor in Switch. we had worked with the company for at least 12 months before we engaged in the due diligence process, and then the process went relatively quickly after that. However, we were involved in understanding that opportunity. We're working with another company that we've identified now, and we've been working with that company for 18 months because they were too early in the cycle. We really liked what we saw early stage, and we're now getting to the point where we think there might be something there. So BDC's objectives is we really want to build those flagship companies. We were an early investor in Ballard, Creo, very large companies in Canada, Xantrax, Tundra Semiconductor, etc. We need to find disruptive technologies that can launch an industry. Ballard's an example. And you have to have some fun and make some money, because if everybody's motivated and having fun, then it goes a lot easier. And this is a very difficult thing to do. So the reality is that not a lot of approaches will make it. If you look at my partners, IRAP's very broad. They touch a lot of businesses in all sectors and do an amazing job in helping innovation come to Canadian companies. 99% of their contact base is not venture capital based companies. SDTC, a little bit narrower. Focus on a specific area. They touch a lot of companies. We'll invest in 50 projects a year, maybe less. A third, maybe a tenth of those may be VC-based companies. As you can see, as the approaches, as the numbers come in, it whittles down pretty quickly to about 1% of the companies that contact VCs actually get a term sheet or get funded. But it's a very high-risk industry. So a lot of deals fall short. In fact, there's more losers than winners in this business. But you know, you can only lose 1 time your money, and you can make any multiple of your money on the other end. So even if you have a term sheet, the hard work has just begun. And you know, we use the term living dead in the industry. I'm not sure it's the appropriate thing. Those are very good companies. And I do want to make a comment here of the 100 approaches. Many of those are very, very good companies. They're just not venture capital companies. And in some instances, venture capital might kill that company. So with that said, the odds are tough, but the rewards are great. So with that said, I have a team across Canada that currently work with me in the AAAM team. I run the team out of Vancouver. Jeff Catherwood, who many of you know, is also in Vancouver. We'll be both at the Banff Venture Forum next week, if any of you are up there, and we'd love to talk to you. And we have offices in Montreal and Ottawa, Toronto as well. So thank you.